Corporate finance practice problem using OneNote. Cost of debt after tax, problem 1. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side in the practice problems, then down in the 1114 cost of debt after tax prob 1 tab. Also note that when using OneNote, take a look at the immersive reader. Many of our presentations up top will be down here in the text area as well. Same name, same number with transcripts. Transcripts that then can be translated into multiple different languages, either listened to or read in those languages, being then a good complement to the presentations up top. Closing the icon out, we have our information up top. We'll go through the calculations then on down below for them. Keeping in mind when we're thinking about this topic here, we're thinking about financing options for an organization. You can categorize financing options, how they're going to basically finance their operations, get money, right, in two different categories. 1, debt, and 2, equity. We're going to be focusing in on debt here. When we think about debt, then the typical thing that we have to pay with regards to debt, the cost of the debt, is the rent on the purchasing power of the money that we have to pay to whoever we basically got the money from, and that is going to be called interest. So we have interest. Interest typically straightforward to calculate, although there could be different formats of how the interest will be paid. The further complication here will be taxes. Taxes are always complicating the situation. We're dealing with something that will be on the income statement. It's an income tax that we're talking about. Therefore, it will have a tax impact. Taxes are always backwards with regards to what we would normally be thinking in general, meaning normally we don't like interest because that's like paying rent on the purchasing power of money. Not good. But for taxes, it's a deduction, good. Therefore, we have this kind of counterbalancing impact in terms of the impact in total when we take into consideration taxes with regards to debt financing. With equity financing, we don't have that same kind of situation because we have a different, it's not something that's going to have a tax impact. It's not an income statement type of transaction. So keep that in mind. We'll get into that more later. So we're going to say the interest rate, let's say, is 5% and the tax rate is 30%. Let's not even think about the debt first. Let's just think about the rates. And then you could basically think about and figure what the cost of debt after tax on a percentage basis would be just simply with the rates. Now, then we'll add the 100,000 and just add the debt because I think intuitively many people would understand this better by basically having the debt and then calculating it in that format. But let's first do this interest calculation. This is very important to have, like just in your mind. You kind of just want to memorize the formula, but you also just want to intuitively understand what's going on as well. So that'll help you to memorize it. So we're going to say the cost of debt after taxes calculation. We're going to say the interest rate is going to be the 5%. And then we're going to take 1 minus the tax rate. So the tax rate is 30%. Remember that when we talk about the tax rate, we have a progressive tax system, meaning as your income goes up, the tax rate could go up. So it could be more or less progressive in terms of the system. But also note when you're making decisions, you're often making them on, as economists call, the margin, meaning the last decision that you're basically making. Therefore, you might be making the decision and just considering your highest tax rate because that's going to be the one that has the most impact on your last decision. However, it could be more complex than that in some situations if it could have an impact on multiple different tax rates. But that's one reason why we could basically use one tax rate here that we're going to say we're probably using the high tax rate, not the average tax rate most likely, because we're making our decision at the margin. That's where our tax is at that point. So then we're going to have the 1 and then the tax rate. So we're taking 1 minus the tax rate. You could think of the 1 as, of course, 100% or 1 minus the tax rate, which you could think of as 0.3 or 30%. That would then give us the 70%. So then we take the 70% times the interest rate of 5%, and that's going to give us our 3.5. So the basic formula you have is the 5% interest rate times 1 minus the tax rate. So you kind of just want to memorize that, but if you understand it intuitively, you don't really even need to memorize it. You'll basically kind of see what's happening intuitively. So it can be a little bit confusing when you think about this with no actual debt number that you're basically calculating. But here, of course, we have the interest rate, which would be the interest rate times the debt, that would be the normal debt that we would calculate, but then we got to take into consideration we have a tax impact for the deductible portion. What's the relation of the tax impact? Well, if we had 100% of the tax impact, which would basically we can think about as the deduction that you would get for the interest, right? That would be the impact on the income statement, basically on net income. And then we subtract out the tax rate, the 30%. That tax rate, the 30% of it, is the amount that we can kind of think that we're going to have reverse out due to the tax impact. In other words, we're going to have to pay the interest of that amount, which is not good because we have to pay it, but we're going to get a tax benefit. In other words, we kind of get it back in some ways of the 30%. So that leaves us with the 70% that's not going to be basically impacted or reversed out with taxes. So now we've got the 70% times the interest rate of the 5%. That means that we have the cost of debt after taxes percent at the 3.5%. So when we think of the cost of the debt, then normally we think, well, the cost of the debt is the 5% interest we have to pay, just like we would think the cost of the rent that we pay on a building is the annual rent that we pay or something like that. The cost of the debt would be the 5%, but if you kind of compare that to other options for financing, I need something more specific. I'd like to take into consideration the tax impact because I get to deduct the taxes. And if I think about other options of financing, such as equity financing, I don't have to think about the taxes. Therefore, that's going to be a relevant issue with my decision-making process between the financing decisions. So I need to get my after tax rate, which would be the 3.5. So that's going to be the 3.5 after tax. So we can compare that to other options of financing without even figuring out the amount of financing we need, the amount in this case of like a loan or something like that, or the debt that we would then be issuing. But it's useful to then calculate with what we would issue. Most people, I would think, would benefit by actually plugging in 100,000 or some kind of amount that you figure that you're going to be borrowing or issuing debt in some type of way, and then think about this intuitively in terms of what is going to be the amount you're going to be paying in interest, what's going to be the benefit on the taxes. So let's do that now. That would be something like this. I think this is useful to do. We do this in Excel too, so you could take a look at that. If I was seeing this problem up top and I'm not fully understanding it in my mind, or I want to prove it to myself, I might go through a calculation like this. I'd say, well, all right, then the interest calculation is 5%. We're assuming that's an annual rate here. So if I take the debt of 100,000, which we can just make up, put in some debt number, we're assuming 100,000, times the 5%. If that was the case, then we would be paying interest of $5,000. That would be the normal cost that we would have, the 5,000. But then there's a tax impact. That 5,000 is going to be deductible, and therefore we're going to get a tax benefit of deducting the interest. Remember, taxes are completely backwards, and so we got to say, all right, well, now there's a tax benefit. If we have the tax benefit, we can take that deductible interest, which is now an expense to us, or a deduction, right? An expense, which would be kind of like a business deduction, times the tax rate, which we're saying is 30%. It's going to have an impact of the 30%. Then, therefore, we have a tax benefit of the 5,000 times the 30%, or 1,500. So if we were borrowing 100,000 and 5%, we would be paying 5,000, but 30% of that 5,000 we kind of get back in a way with the taxes because we get to deduct it and get a tax benefit. So the 5,000 minus the 1,500 leaves us with the cost of debt after taxes on a dollar basis of the 3,500. So then I got to think, well, I would like to see it on a percentage basis. So we could say, all right, well, then let's just take the cost of debt after tax on a percent base. Let's take that cost of debt after taxes, the 3,500, compare it to the debt itself, the 100,000. 3,500 divided by 100,000 would then give us the 3.5%. So that's the cost of debt after tax on a percentage basis. So you can get to it nice and quickly up top with this formula here, interest times 1 minus the rate. And then intuitively, you can kind of prove it to yourself by doing the normal type of calculation. You can imagine this being like on a tax return here, that you would be basically doing and figuring that and say, okay, yeah, that kind of rings true to me. Now, when you're doing an actual calculation, you might shorten this out. And if you are thinking about a situation where you have a $100,000 debt, that or issuance or debt that you're going to take on in some way to finance the company, you might do the calculation something like this: 100,000, and then figure out the cost of debt after tax percent, which is going to be just like the first calculation we had, which is the 5%, and then take into consideration the tax effect, 1 minus the tax rate. This is the first calculation we did, right? 5%, the rate, times 1 minus the tax rate. That would be 100% minus 30%, or 1 minus 0.3, giving us 0.7 or 70%. And then if we multiply that out, the 5% times the 70%, we get the 3.5. Remember to be careful about decimals and whatnot. 0.05 times the 0.7 would give us the 0.035, or if we make it a percent, 3.5%. Then if we take that 3.5%, we can then multiply it times the 100,000 times, and we get the 3,500, the 3,500. And you note this is a much quicker calculation that I can do with an actual number. So up top, we did the calculation just thinking about the percent. You want to basically memorize this formula, understand it intuitively. That's going to be the rate times 1 minus the tax rate. And then you can apply that out to actual numbers, the financing being the 100,000 in this case, instead of doing this longer calculation up top, which I think is useful to do and gives you more information. But if you're trying to do a quick calculation and present it to somebody, then you can also do a nice quick calculation here by taking the rate times 1 minus the tax rate. And obviously, if you're presenting to somebody here, what I would do normally is basically calculate this out. If someone doesn't really understand this thing that we're talking about here, it can be a little difficult to explain basically on a percent basis. Then I would be ready for that and say, okay, let's break it out this way. And I think this just intuitively will make more sense to people if they had the attention span to go through the longer calculation for it. So highly recommend doing this kind of practice problems in Excel. We have multiple problems in Excel, rework them multiple times, and just get a good feel for them.